Hello, I'm Alexander Urpi, the CEO of Emergent Financial Services. I'm here with our Chief Investment Officer, Xavier Urpi, to talk about interest rates. So Xavier, what is the significance of low rates on the economy and the markets?
Well, Alex, that's a fabulous question. And let's think about it. We've never seen these low interest rates ever in history, right? And part of it is because what's transpired with the coronavirus. But let's take a look at it from perspective really of the consumer, at least in this case, and then others. But from the consumer point of view, right, the idea that we can borrow at these low interest rates is fabulous. Anybody that's looking to buy a car, anybody's looking to buy a home or whatever, that borrowing cost is going to be very low. So it makes it much easier for them to go ahead and buy homes, buy cars, etc., than it would be if interest rates were larger. On the other hand, savers are in a dilemma that they're investing in the bond market, for example. They're earning 1 to 2%, maybe 3%. So from a perspective as like a senior citizen that used to be able to maybe live off their savings in a way that either money market rates were at 6 or 7% or bonds were yielding that much, they could live off their savings. That's not the case anymore. So again, there's a balance there of investors, people that need to borrow. It's paradise for them. But on the other hand, people that want to save, they've got to find other ways. Let's look at it from perspective of corporations and certainly the government. Corporations, if they need to borrow money, they need to go to the bond market or to the bank and borrow money to build a new factory or build a new product or do research. If they need to borrow money in order to do that, obviously it's fantastic that the interest rates are low because they're spending more money on what they need to do to earn, right, on their investment rather than pay interest. The government, as we all know, they're borrowing at this point trillions and trillions of dollars. So the less interest that they pay on that debt, the better they're off. And of course, the better they're off, the better we're off. Because if interest rates go up on government debt, then the only other way for us to pay for those is for our taxes to go up dramatically. So to a certain respect, overall, low interest rates at this point in time, without any doubt, is very beneficial so that we can get this economy going again.
So is there really a distinction between bad debt and good debt? What would be an example of the difference?
Well, absolutely. I mean, there is a big difference between good debt and bad debt. And so let me give you an example of good debt, right? So you are a 30 to 35-year-old, you've saved some money, you now want to invest in a house, right? And you realize you just don't have enough money to buy the house as is. What you need to do is really borrow some money, right? So that debt that you borrow money, that's debt that you have, but that money, that debt that you have is good debt. Why? Because you still have to live somewhere, so you don't have to pay rent, you're paying a mortgage, and two, you have equity. In other words, you would hope is that house over time will go up in value, therefore that's good debt. Sample of bad debt is you've got 2 televisions and you decide that you want a third television. You go out and buy a third television, but you don't have the money to pay for it, so you borrow. You borrow using your credit card, and now you're paying 15, 16% on a monthly basis on that television. So if that television costs you $600 over a 5-year period, if that's how long it takes you to pay that back or longer, right? You're spending 3-4 times on that television you would have. So that's not good debt. In other words, not bringing you anything other than maybe a little bit of more luxury in obviously in your home. But whether or not you can live without it is the key question. So without any doubt, whether it be a corporation, whether it be a person, an individual, there's a huge difference between good debt and bad debt.
Going forward then, how does a financial advisor adjust to a low interest rate environment like this one?
Well, a financial advisor, as always, has to look at multiple criteria when making a decision what type of portfolio to create for their client, right? So without any doubt, I mean, we are now living in a situation in the world whereby what used to be a safety net, which was bonds, and in particular maybe treasury bonds and high-grade corporate bonds, that was your safety net. And that safety net was yielding you something, meaning it was giving you 3, 4, 5% interest, right? At this point, we're working in a level where that interest rate is so low that essentially what you're looking at is you have a cash component more than you have a growth component that is a safety net. So the way to work with that is really to begin to balance your portfolio. Are there any other instruments out there that have earnings or have dividends or interest that can essentially give you the type of return that you're looking for from a cash flow perspective without adding an enormous amount of yield? But I think without any doubt, I think the level of expectations from a cash flow perspective on portfolios has to be diminished, because certainly the markets are very high, and with interest rates so low, there isn't a way to protect the portfolio without having some form of, again, short-term investment grade type of securities that you know will protect you from a down cycle in the market. In other words, if stocks drop 30-40%, you have something there that's holding its value. But over time, you know that that's not going to grow very much. But again, it's a safety net. And so every single client has to be different. Every single client is different, I should say. And therefore, every portfolio has to be different depending on the client's goals and their risk attitudes, right? How much risk they're willing to take to achieve those goals.
Thank you, Xavier. And thank you for joining us for this Emergent Financial Services interview.